All right. I'll get into what I really wanted to cover today, given it has an extreme timing nature, and that is the instant asset write-off rules. Now, I'm going to go through the theory behind it, and I'm going to go through some practical examples too to show how powerful this is. And you've got to do, part of the reason I want to have it now is we've still got 5 months left. I want each of you guys out there who are running your businesses to look long and hard at what I'm covering in this session. Think about how it applies to you, both with equipment and vehicles, and think beyond that and outside the scope of that, and how beneficial this may or may not be to you. And I think then it's really important that you have a session with us to really get into the nitty-gritties and make sure that you maximize every cent possible in this space, because I know COVID's created this window, but I don't think this will ever happen again. Touch wood, I know I want bloody COVID again. I'm sick of hearing about it, but hopefully it has created some one-off windows that are amazing that I've never seen in the whole time I've been doing accounting. So we've got to make the most of this opportunity as well. That's, I guess, what I'm wanting to say. So, instant asset write-off. Basically, businesses are able to claim 100% amount as a tax deduction for the business proportion of your cost of your asset when it is first used or installed ready for use. Now, for example, instant asset write-off, and this is a really important element, can be used for multiple assets as long as the cost of each asset is less than the threshold, and it's new and secondhand, so it doesn't have to be new. So what that means is, if you want one of something and it's under the threshold, and you want 10 of that same something and they're all under the threshold individually, not as a collective, individually, it's all deductible.
What's
so
the threshold? Oh, sorry.
Can you wait till I've gone through the seminar? If it can't be used for assets that are excluded from the simplified depreciation rules. Now that includes capital works costs and structural improvements. Now, to keep that simple, examples of capital works cost, if you think about building a home, that's all the hardcore stuff. That's your plumbing, your slab, your roofs, your floors, your electrical, your windows, your walls, cupboards, all the stuff that lasts 40 years, you cannot use these rules for. And there's also different rules for cars, which I'm going to be covering in detail in a minute. Now, what you need to do, and you'll know this by the end of this, is check what you're eligible for your business. And by the end of this webinar, you'll know how to apply that to know exactly what your tax benefit is. The recent changes is, and for all you guys who had tax planning sessions with our clients, who had tax planning sessions with us, albeit a little bit later than normal because of COVID, you would have been told that it went from that the assets were bought from 12th of March until 30 June. What happened not long after 30 June was that the government extended it to 31 December. So now we've got this window to 31 December to make the most of these rules. Because let's be honest, from the 12th of March, a lot of us were struggling with COVID for about a month or two in there. So we had about a month there to really look at equipment and whatever else we're trying to claim. So we didn't really have the opportunity to give it a lot of thought and planning. Now we've got 5 months left till 31 December. It's an amazing opportunity to plan and make the most out of this tax-wise. So the threshold is each asset, which Anita asked a minute ago, is 150 grand. It's up from $30,000.
Sorry, I've just taken it out.
And the eligibility has been expanded to cover businesses with a turnover of less than 500 million, up from 50 million. So they're catering these rules to big business too. Now, in the upcoming slides, I'm going to cover eligibility, thresholds, exclusions, what happens when the assets go above the threshold, how you claim it, and what happens when you sell. So I'm going to cover all that over the next few slides. The eligibility to use the instant asset write-off depends on your turnover. So the total ordinary income of your business and any associated businesses gets included in this aggravated turnover. aggregated turnover, sorry. The date you bought the asset, when it was first used or installed, ready for use is important, and that the cost of the asset is less than the threshold, which we now know is 150 grand. If you run a small business and choose the simplified rules, you must use the instant asset write-off on all eligible assets. Seems a bit silly to me to have that in there. Who's not going to want to claim something when they can claim something, right? So I don't think too many people would be worrying about that, but that doesn't give you a choice. It means that if you use this threshold, you have to write off all your assets that qualify. Now, from 1 January, the instant asset write-off will only be available for small businesses with an aggregated turnover of less than 10 mil, which is what it used to be ages ago. And how's that? The threshold goes back to $1,000. It hasn't been $1,000 for a long, long time. And just quietly, I can't promise this, but I half expect that to be extended because, as you would have all known, if you listen to media and read and watch and all the rest of it, you'll know that stimulating the economy is the way we're going to get out of this. Part of the stimulation will be to encourage people to buy equipment and assets. So dropping it back to $1,000 hardly does that. Now, will it stay at 150? I highly doubt it, but I'll show you in the next slide. As you can see, it hasn't been $1,000 since 12th of May 2015. It was prior to that was when it was $1,000. Then it went to 20 grand, then up to 25 grand, then up to 30 grand, and up to 150 grand. So I half expect it might drop back to the prior threshold of 30 grand or 25 grand or 20 grand, somewhere in there from 1 January. So you still get encouraged to buy equipment and assets, but not at the really, really high rate of 150 grand. So exclusions. There are a number of assets that are excluded. Now I want to go through this because this is really important. Now, this is really talking about cars. You know how I said cars was one of the exclusions? I want to pause for a moment about cars. Obviously, with this less than 150 grand threshold, it's really talking about equipment and cars. They're the main, assets that people buy for their businesses. So with equipment, it's straightforward, less than 150 grand per item, 100% deductible, as long as it's not a capital works item or a structural improvement. Cars are a little bit different, but when I dug a bit deeper recently, I realized, and which is why I wanted to run this webinar, that in the past, a lot of accountants deemed cars taboo. And look, let's be honest, a car is a necessity, like you have a car because it's a necessity. There's two types of cars. There's cars that you need to have to run your business, and there's cars you like to have for lifestyle and a benefit of running a business and then being able to claim it. Both fall under this category, whether or not it's a necessity to run your business or a lifestyle choice. Cars under these rules are never going to be this tax effective again, which is why I really wanted to mention it. And I'm more than happy for each of our clients that we have a one-on-one discussion about cars and how you can benefit in your business, because it's really got to be a one-on-one for each business to see what type of business and how they can potentially benefit from having a car. But what I do want to say, a lot of accountants don't like cars, and I get it. However, what's important is if you're going to buy a car or you're thinking about buying a car, make sure that you make an informed decision before you do it as to what you're going to get out of it and how you can maximize your deductions for that vehicle. Because at the end of the day, whether you're going to buy a car as a necessity for your business or whether you're going to buy a car as a tax deductible lifestyle benefit, either way, you still want to get the maximum tax deductible usage within the rules that you can. So this is where the discussions can be had before you go off and buy these things to make sure that both you and us are all on the same page and that you go in armed with everything you need to know, knowing what you're going to be able to claim and structuring it that way from day one. So that being said, car limit applies to the cost of passenger vehicles designed to carry a load less than 1 tonne and fewer than 9 passengers. The 1 tonne relates to the maximum load you can carry. The payload capacity is basically, it's getting a bit technical, the gross vehicle mass as specified on the compliance plate by the manufacturer, reduced by the curb weight of the car. Reality of it is, forget the last little bit, I'm not going to go through it, I'll put it in there for the detail conscious people. What it means is a car by definition is one that's, to be a passenger vehicle, it is one that's designed to carry a load of less than 1 tonne and or fewer than 9 passengers. The 1 tonne capacity changes the boundaries, which we're going to cover in a minute. The car limit for the 1920 tax year is 57,581. The car limit for the 2021 tax year, that is where we are now, is 59,136. Now, the instant asset write-off is limited to the business portion of the car limit relevant to the tax year. So I'll go through an example. For 1920, the car limit's 57,581, right? So if you've got a logbook, and you know we've got webinars on logbooks and stuff too. So if you want to know more about how to create a logbook and how to get the most out of your logbook and make sure you dot the I's and cross the T's within the rules, there's a webinar on our website about that too. But let's say you use your vehicle for 75%. How that works is the car limit is 57,581. Under the instant asset write-off rules, if you've got a 75% business use, you can claim an instant tax deduction of 75% of the 57,581, which is 43,186. So stop and think about that for a minute. That's one hell of a tax deduction that you've got a window of opportunity to maximise if it's appropriate. Remember, this isn't appropriate for everyone, but if it is appropriate, and this is where a one-on-one chat comes in handy, between now and 31 December, remember it's got to be installed and ready for use before 31 December. So for a car, that means you've got to basically drive it away, right? To be installed and ready for use means you get in the car and you take off and it's yours, you're driving it. That's installed and ready for use before 31 December this year. Having said that though, that's one hell of a tax deduction, right? That you've never been able to claim before for a car at all. So that is an extraordinary timing rule. Now, if you buy a car for more than that, we're going to cover an example in a minute, the excess over the car limit is lost. You don't get to claim it at any point in time. Now, if your vehicle, I'll go back to this about the 1 tonne carrying capacity under the gross vehicle mass. If your vehicle is not a passenger vehicle, in other words, the car that carries more than 1 tonne, this car limit does not apply, and you can claim the cost of the vehicle as long as it is less than the 150 grand threshold. Stop and think about that for a second. If you buy a car that's not a passenger vehicle and it's effectively a car that has a more than 1 tonne gross vehicle mass carrying capacity, you're not limited by the 57,581 or the 59,136. You're limited by the $150,000 threshold. So potentially you can buy a car as long as it meets those rules up to $150,000 or less than $150,000 and you can fully write it off. Once again, please seek your accountant's advice to work through this in detail before you go off and spend these sort of coins on buying cars and luxury cars or utes or whatever. Now, if you are a small business using these rules and the cost of the asset is the same or more than the $150,000, you must place the asset in a small business general pool, which is what we've been doing anyway, where basically you get 15% deduction in the first year and 30% thereafter. Now, a couple of little pointers. The entire cost of the asset must be left less than $150,000, not including any trade-in. So you don't get to net the trade-in off against the cost of the car, or I'm using cars because this is really what this is talking about. You don't get to offset the trade-in. You've got to look at the gross cost of the car and and it must be less than $150,000, not factoring a trading in. And the other important element is whether it's GST exclusive or inclusive, depends on if you're registered for GST. So what that means is, working on the assumption that almost all businesses are registered for GST, what that means is that the 150,000 threshold, what that means is the asset you're buying or the car you're buying has to be less than $150,000 GST exclusive. So remember, to be able to claim the 75% of this, or the cost of the passenger vehicle, where it's over a ton carrying capacity, it's still got to be the cost of that car overall, exclusive of GST, has to be less than $150,000. But what that means is you can go and potentially go and buy a ute or whatever that's greater than a ton carrying capacity. As long as that ute is GST exclusive less than $150,000, you can write that car off fully. Or if you go and buy what I would call a luxury car or a passenger car, that might be more than the 57,581 or 59,136, as long as the total cost of that car, excluding GST, is less than $150,000, then you still get to claim, in this example, the business proportion of the cost limit, which in this example is 57,581. So if I had a 90% business use, I could claim 90% of 57,581 as a full tax deduction, as long as the total cost of that car is exclusive of GST less than $150,000. If you're not GST registered, then it's the inclusive cost that matters. But I would imagine almost all businesses are GST registered. So it'll be the GST exclusive value of equipment, and GST exclusive value of the car has to be less than $150,000 to be able to write it off. Now, in relation to private use, the private use comes out second. So you don't take out the private use and that's less than 150. That's not relevant. The total cost of the car has to be less than 150, and then you worry about private use. Now, if you write off your asset, so let's say you go and buy a car, let's say you bought a ute that carries more than a ton, and you bought it for, whatever, 80 grand, 100 grand, whatever the figure, and you've written it off as a tax deduction when you bought it. What happens is when you sell that car down the track, that means whatever you receive net of GST is income to the business, because you can't have your cake and eat it, right? So that means if you've been able to claim it as a full tax deduction, whatever you sell that car for, ex GST or net of GST, is taxable income to your business. And they give an example: if your asset's later destroyed by a fire or flood and you receive an insurance payout, then likewise, net of GST, that payout will be included in your taxable income for your business. Now, I've got a couple of examples. Example one, purchase of a luxury car for business purposes. So they run a small irrigation business. In March 20, they go and buy a luxury car designed to carry passengers for $80,000. In other words, it's not meeting the greater than 1 ton carrying capacity, so it's a passenger car, right? So that means the cost limit comes into it. So the instant asset write-off at the time they first use the car is 150 grand. And for this example, to keep it simple, we're assuming 100% business use. Now, the cost of the car is limited to the car limit, which is 57,581. And as the cost of the car is above 57,581, the business can only claim the instant asset write-off of 57,581 and can't claim anything so the remaining bits between 57,581 and 80 grand. Now I'm working on the assumption that 80 grand is ex GST, right? I'm not going to say it's including GST. That 80 grand is ex GST. So it's under the $150,000 asset, tick, right? Next question, it's a passenger car. Okay, the cost limit comes into it. It's above the cost limit. Okay, then I'm restricted to claim the business use portion of the cost limit, which in this example is 100%, which means you can claim 57,581. If it was 90%, you can claim 90% of 57,581. The rest of the asset is effectively lost. So you can't claim anything in addition to that. Now, if in the same year, they purchase a ute for $65,000 ex GST, the ute is not designed to carry passengers and has a carrying capacity of more than a ton. So first question, is it 150,000 ex GST? Tick. Is it a passenger car? No. Okay, the cost limit's not relevant. That means because it's under 150, you can actually claim a full deduction for the $65,000 as a 100% tax deduction. Purchase of a car with a carrying capacity of more than a ton but less than 9 passengers. Okay, so he purchases a vehicle for $70,000 for his business. It's 100% for business use. It's ready for use on the 3rd of June. Payload over a ton. Is it under 150,000? Tick. Was it installed and ready for use before 30 June? Tick. Does the car limit apply? No, because it's got a payload capacity of more than a ton. Therefore, the ex-GST cost of 70,000 is a 100% tax deduction. Right. I'm hoping now you guys would now understand why it's so crucial that you guys get your head around A, initially JobKeeper 2, but B, the asset rules, because there is a window of opportunity here from 12th of March to 31 December, where and look, the other thing I should say in here, I didn't cover this, but the other thing I should say, you don't have to fund these things by cash. You can take out a shadow mortgage or any form of finance that the banks will give you to buy your equipment or to buy your car, and you're not using your cash to buy it, but it's still subject to these rules. So there's still potential to fully claim equipment under $150,000 ex GST, or cars up to the cost limit ex GST, or over the cost limit and under 150 if it's a carrying capacity is more than a ton, and you still get 100% tax deduction or a large, massive tax deduction, even though you finance the asset. So I can see now with some careful planning and some one-on-one discussions about what's appropriate, what equipment you need, what equipment you would like, and work out the parameters of both, what cars you need, whether that be a passenger car, and up to the cost limit, or a non-passenger car and carrying capacity more than a ton and up to 150 grand. There was some careful planning here. There is some, I think, some amazing one-off opportunities to get some wonderful 100% tax deductions or massive tax deductions that you've never been able to get before, and I don't think you'll ever be able to get again. So, any questions? I'll pause for a second. I'll just wait. Sorry, guys. I'll just give everyone a couple of minutes to ask any questions. All right, I'll proceed forward as if there's no questions. I know it's late at night, guys. And look, thank you for persisting. I've gone quickly through this because A, it's late at night, and okay. Question coming in: if I finance a truck, can interest still be claimed? Yes. So, good question. Let me explain how finance works. Whether you finance equipment, whether you finance a carrying capacity car more than a ton, a passenger car less than a ton, or a truck, which clearly is more than a ton and not relevant anyway, it's still subject to in relation to the finance, the interest is claimable as a tax deduction to the business. Now, if it's a truck, for instance, because it's carrying capacity of more than a ton, it's going to be 100% business use. So what that means is, up to, as long as the truck ex GST is less than 150 grand, then you'll be able to write off the cost of the truck fully, and the interest on the car, of the truck, will be tax deductible, as will all the running costs, you know, the rego insurance, petrol repairs, etc. I hope that makes sense. And the next question I've got is, because I know there's some dentists on here as well. Most dentists are going to be using their car for commuting and then going to courses. Can we claim? Good question. It's a question probably beyond the scope of this, but there's another question coming, which I'll answer in a second. About the dentists and their cars, right? This is where the one-on-one discussion needs to come in, because there's so many variables that are beyond the scope of this webinar, right? That also impact on what tax deductions and what benefit tax-wise you get out of it. But I will say this. In the last couple of years, as we've been working a lot more with dentists, I've been having a lot more one-on-one discussions with you guys, and quite a few of you guys have coming over have said, oh, my previous accountant doesn't like cars and couldn't claim and couldn't do this and couldn't do that. How I like to look at things is it doable? Can we do it? How can we do it? And is it viable, right? So I don't just say no. I explore it with you. I have a one-on-one chat. We go through a bit more detail about what sort of usage you have of your car and how you drive it and what you drive and where you drive and all that sort of stuff. And that forms a very large part of the logic behind whether the car's justifiable. Because obviously, to be able to still get a tax deduction, you've still got to get a large business use, right? But what a lot of you guys won't realise is what you think is not deductible is not necessarily what isn't deductible. So it's the one-on-one chats come into exploring how you use your car, what you drive it for, what the purpose is, where you travel, who you see, when you go, all that sort of stuff we explore in detail one-on-one. And I would say in a large amount of cases, there are some exceptions, but in a large amount of cases, it's worth exploring because it's not black and white. A lot of this is grey. And when you actually dig a bit deeper on all this stuff, it starts to open your mind up and it becomes a lot more viable. And quite a few of the guys I've had conversations with have ended up buying cars and doing logbooks and claiming them through their businesses because they've never really had it explained to them how it works, what's involved. We don't just superficially look, we dig right into it and get into a lot more detail. And that's when you start to have your eyes opened, because a lot of accountants are black and white. I don't think that helps anyone to be black and white. I think you've got to be black and white at times and then grey others. And then in the grey bits is making sure you understand how it works, what you do, and making sure that you understand how all this stuff comes together and how you can, and how viable is it from a tax deduction point of view, from a business use point of view. Is it for you to be able to have a logbook prepared to justify your business percentage, which then justifies the tax deductible side of your car usage? So I'm sorry it's a bit vague, but it's hard because there's a lot of variables that go into it, and that's why that one-on-one calls have to be had. There's another question about SUVs and station wagons. SUVs and station wagons are deemed to be passenger vehicles because most SUVs and station wagons are not designed under manufacturer's warranty to have a payload capacity of more than a tonne. So that means that puts that straight into the business use proportion, which then falls back into the categories I've just started talking, which is where one-on-one it becomes super crucial to explore this at all levels so you can understand the viability of your ability to buy a car and what sort of business usage you may be able to get from that based on your usage, which you didn't really understand because you've never had it explained to you in detail. But it's certainly worth exploring, especially more so given the rules that exist right now, which give everyone the opportunity to get some fairly serious tax deductions for both cars and equipment in the next 5 months. Having said that, if you're going to buy a car and it's a passenger car, you certainly want to, before you go off and buy a car, have a really good discussion to know what your viability is business use wise before you go and buy the car. The last thing you want to do is go and buy a car and go, oh, can we have a chat now about how it works and, what sort of logbook I might be able to, what sort of things can I claim for my car and what usage and all that. It's too late then. You've got to have that discussion before you buy the car, because the idea behind it is you have the discussion to understand what you can claim based on what you do, and then buy the car and then put your logbook together to justify, to support the usage, which then, as you can see, the flow-on effect is you get the business use proportion as a tax deduction. But given the value we're talking about here, I think there's a really wonderful one-off opportunity to seriously explore all this. And I think you owe it to yourselves to explore it in detail. And we certainly do a lot of this anyway, but I can see with these rules, we're going to be having a lot more discussions in the next few months as to the viability of cars and business usage and all that based on what your usage is and et cetera. So any other questions? I'll wait about a minute. For everyone out there who's not one of our clients, and there are some people on here that aren't our clients now, if you're interested in having a one-on-one discussion with us, no obligation, no cost, no obligation, please feel free to contact our office, because we pride ourselves on being a very proactive and outside the box thinking accountant within the rules, of course. But we're more than happy to have a no obligation discussion where, you provide us a bit of information. I do a thorough analysis, and it's with me personally. I do a thorough analysis of your information. And then we have a one-on-one discussion where we explore at length what's currently going on with you guys and how it could be improved. So if you guys are interested in that, please feel free to shoot an email in and we can have a discussion, no obligation discussion. And I think you'll find that discussion very fruitful. So any other questions? No? All right. Well, thank you everyone for giving up your time of an evening, your personal time and your family time. I very much appreciate it. I'm glad you could come on to this two-part webinar. You're going to get a copy of this webinar in the next, probably on Monday, because the person doesn't work tomorrow who does this. So you'll get emailed out to you guys on Monday. So please review both at your leisure. And if you've got any further issues or questions, or you want to have a no obligation discussion at any point, please instigate that. Otherwise, please seriously consider what we've covered tonight and make sure that you get the most out of these rules in the next 5 months, because I think this is an amazing opportunity that I don't think will ever rear its head again. So until then, guys, look after yourselves, and thank you for your time.